Okay, this is take two of College Coffee Talk for today, Thursday, April 6th. Andy Lockwood here from Lockwood College Prep. We just changed our name. And today's episode is about a question that I got a lot of commentary and follow-up questions on. Last night I spoke at at Bronx Science in the Bronx, and my daughter Sammy, who was helping me, described it as a mosh pit. There were like 200 people there. We got all sorts of questions firing away, giving me more ammunition for College Coffee Talk. College Coffee Talk is a show where I go over every question that I attempt to go over every question that we've gotten over the last couple of years. So I had talked about a one loophole. There's actually more than one for small business owners, and the gist of it is that the FAFSA, the main financial aid form, asks specifically, if you are self-employed, asks you to value your business. It is College Coffee Talk after all. So the deal with that is there's a very narrow definition of how to value your business on the FAFSA. And I usually think of a client of mine, Tina, who is self-employed. She actually lives in our district, and she and her husband own a contracting firm, and they have all kinds of equipment, and they have big contracts, and it's a pretty nice business. Well, in her situation, she came to me after the fact. She wasn't my client when she filled out the forms herself, and she got some pretty bad results. NYU gave her 0. Syracuse, a bunch of other very expensive schools, gave her eldest daughter, Paige, nothing. So she talked me into reviewing her forms. I looked through everything, and I noticed that her big mistake, her fatal flaw, was that when she answered that question, what's the value of your business, she mistakenly used a common sense answer, a real world answer. And in financial aid, things aren't necessarily tied to the real world. So what she did, I believe, because I just ran into her, this is now 2 years we've been working with her. I just ran into her recently, and I think what she did was she pulled a value that either her accountant had come up with, or she and her accountant had come up with together to give to their equipment lenders, because every year they have to provide financials to various people that they do business with. So the problem is that that overinflated the value of her business, and therefore her on paper, her ability to pay for college, her resources that she could use to pay for college, and that's why she got nothing. So we quickly corrected the forms and resubmitted them, and lo and behold, NYU and everywhere else gave her a lot more money. NYU went from 0 to $25,000, 25 grand. And same thing for the next year, an additional $25,000. So far it's been a $50,000 swing. Do you want to know what that, how to value her business, what the mistake was? I think you do. The answer is that the FAFSA says very clearly, if you employ fewer than 100 employees, the value of your business is 0. Now I'm paraphrasing, I'm just trying to make this simple. But that's really, in sum and substance, what's going on with the FAFSA. So she had overinflated the value of her FAFSA, and she shot herself in the foot in terms of her, sabotaging her ability to pay for college, or to get more money for college. So if you're self-employed, for the most part, the value of your business is 0. Now, just to round out that discussion, to be fair, she also had, because of NYU and all these other schools that her daughter applied to, she also had to fill out another form called the CSS profile, and most of the time, colleges that require the CSS profile for self-employed people also want to see more business disclosures like balance sheet and profit and loss and things like that. But for whatever reason, that did not change the outcome. She still got that extra $25,000 per year for a total of $50,000 so far, and fingers crossed, we're hoping for another similar result this year too. So it's at least a $50,000 swing just from making a mistake. And by the way, she's smart. It's not an intelligence thing. These rules are very arcane and hard to hard to determine, especially when you have to comb through all the fine print. Most accountants don't know this too. So anyway, that's the first loophole I want to talk about. I think it's pretty important. Hopefully you do also. By the way, please share this with any parent, any self-employed parent, business owner, anyone you know. This is good information for them. It could save them a lot of bucks for college. Okay, now, just to switch gears a little bit, many self-employed business owners cannot qualify for need-based financial aid. Many people in general can't qualify for need-based financial aid because their income is too high or other reasons. So if you own a business and you are not able, let's say you show $300,000 per year on your adjusted gross income, on your personal income taxes, there is no way that you're going to qualify for need-based financial aid unless you have like 3 kids in college at the same time. So that might be one strategy to think about. But for most people, that's going to knock them out of the box. What do? Well, if you're self-employed, you have other, what we call tax scholarship type of opportunities to pay for college with pre-tax dollars. So what I want to, just to kind of back up here and look at the global picture, what I want to talk to you about is, this is the opposite type of strategy than if you were trying to qualify for more need-based aid. So if you're thinking about like like a waterfall or a flow chart, the first question is, can this person qualify for need-based aid? And you look at income, you look at savings, you look at a bunch of other factors. If that person can qualify for need-based aid, then the type of strategies that you would deploy would be to move money out of your kids' names if that's where you have it, because money in your kids' names penalizes you way more than other places. However, if that's not the case, if you can't qualify for need-based aid and you're going down a different path and you're self-employed, then the strategy is the opposite. It's to move money into the kids' names, like income, for example, because maybe you can divert income and pay at a lower marginal tax rate. So the big issue is understanding the interaction between the Federal Department of Education Title IV financial aid rules and the IRS rules, particularly when it comes to self-employed people. So, frequently when we do these plans for our self-employed clients, what we call, again, the tax scholarship plans, we are able to come up with between, $1,800 to $5,000 per year per child with these types of plans. And I had a client, I guess last year or a year and a half ago with, everyone's different, but 4 kids, really expensive colleges that 2 of them are going to and 2 are headed toward, 7-figure adjusted gross income. And over the course of the college years, what we figured out, and this was approved with by her own accountant, it was like $103,000 worth of savings that we were able to create for her just because of the types of strategies that I'm talking about, these tax scholarship strategies. So if you're a self-employed person and you have kids headed to college, we are absolutely happy to chat with you. Your best bet is to attend one of our upcoming workshops where I will talk about strategies for self-employed and business owners, which are really the same thing. Even if you're not self-employed, please feel free to register for an upcoming workshop. I'll pop that in the comments section here. The link is lockwoodworkshops.com, and if you have any types of comments or questions, please feel free to do the same. Put them in comments here. Thanks a lot for watching. Please share this. I appreciate all the shares and the funny comments that we're getting. Thanks a lot for watching. I'll be back tomorrow, Friday, for the last episode of the week for College Talk Tuesday. I'm really tired from being in the Bronx last night, I guess. For College Coffee Talk, and we'll speak to you soon. Bye-bye.